Right now, as you're watching this, somewhere in the world, a tanker is loading oil into its hull and preparing to move through a 33-kilometer stretch of water between Iran and Oman. And through that stretch of water flows 1 in every 5 barrels of oil consumed on Earth, 17 million barrels a day, every day. As of early 2026, almost none of those tankers are moving. There are many reasons those tankers aren't moving, but I'm going to talk about the one reason nobody else is. It's a piece of paper, or to be precise, the absence of one. A piece of paper I can almost guarantee every single person watching this video has some version of, whether it's for their house, their car, even their life. Insurance.
The average person in the street, they know how to insure their house or their car or their dog, but they don't think about the global repercussions of insurance pricing on trade.
A group of underwriters in London looked at the numbers, decided the risk was too much, pulled their coverage, and just like that, the most strategically important shipping lane on Earth ground to a halt. So here's what I want to know. How does a piece of paper get that kind of power? Because it turns out the mechanism that just paralyzed the global oil supply is almost 4,000 years old. It was born in Babylon, then arrived in Europe on the same ships that carried the Black Death. It ran through one of the darkest legal cases in British imperial history, where 132 people were murdered. And the question before the court wasn't whether a crime had been committed, it was whether the insurers had to pay. Insurance isn't the thing you buy for your car and forget about. It never was. It's the hidden load-bearing wall inside every civilization that has ever functioned at scale. The thing that decides what moves and what doesn't, what gets built and what doesn't, what's possible and what isn't. And it's been quietly doing that for 4,000 years. Once you see it, you can't unsee it. Imagine you're a merchant in ancient Babylon. Not a small one, a serious one. You have capital, connections, ambition. You've heard that traders coming up from the Persian Gulf are bringing things the city will pay extraordinary sums for. Copper, tin, spices, lapis lazuli, cloth so fine it shouldn't exist in the ancient world. And you want a piece of it. So you do what serious merchants do. You pool everything you own, fund a voyage, watch the ship disappear over the horizon, and wait. And here's the thing about waiting in 1750 BCE. There is no news. There is no way of knowing if that ship is 3 days from port or sitting at the bottom of the Gulf. Weeks pass, then months. And at the end of those months, one of two things happen. Either the ship comes back heavy with cargo, reeking of spice, salt, and profit, and everything you risked was worth it. Or it doesn't. And if it doesn't, your capital, your reputation, your family's future for generations is gone, erased by a single storm you never saw coming. This is what long-distance trade looked like before insurance existed. And here's the detail I can't stop thinking about. When humans first figured out how to turn a loan into something that looked a lot like insurance, it happened here in Mesopotamia, just a few hundred miles from the Strait of Hormuz, the same stretch of water that nearly 4,000 years later, insurance would bring to its knees. Before this moment, maritime trade was basically gambling on a global scale, the kind where the house is the ocean and the ocean never loses. This meant the only people who could participate were those rich enough to absorb the massive losses. This resulted in the same small group of wealthy families trading with each other generation after generation, concentrating power and making the global economy brittle in ways that would take centuries to fix. Something had to change, and it did. The solution came from the thing ancient Mesopotamians did almost better than anyone. They wrote a contract. Now, you need to understand something about the people of the ancient Near East. They were absolutely obsessed with contracts. I'm not joking. Archaeologists have dug up thousands of clay tablets from this region, and 9 out of 10 are legal agreements. Terms and conditions, ancient Near East edition. Historian Dr. Amanda Podney put it simply. The people of the ancient Near East wrote legal contracts almost as soon as they could write anything. So when they needed to solve the problem of ships that might sink and merchants who might be ruined, they built a system and named it. The name is not glamorous. It's called bottomry. It sounds like something a doctor would need to explain to you privately, but what bottomry represents is one of the most elegant financial ideas in human history. Maritime trade was very expensive. One bad voyage could wipe out your family's wealth across generations. So merchants began borrowing money to fund their voyages, and those loans came with a condition that changed history. If the ship came home safely, the person who borrowed money repaid the loan with high interest, sometimes over 100%. This was not a favor between friends. It was a calculated, eyes-open bet on whether that ship would make it back. But if the ship was lost, the debt was canceled entirely. The lender absorbed the loss. The merchant walked away clean, which meant the lender was in clay tablet form, doing exactly what Lloyd syndicates do in London today. This is documented in one of the most famous legal texts ever discovered, the Code of Hammurabi, commissioned by King Hammurabi of Babylon around 1750 BCE. Buried inside his 282 laws in laws 102 and 103 is the world's earliest written framework for risk transfer. If your agent was attacked or abandoned his cargo and could swear by God it wasn't his fault, the debt was canceled and the lender absorbed everything. If you think about it, bottomry changed everything. Before it, a trader who couldn't self-fund a long voyage simply didn't go. The risk was too much, so the trade didn't happen. Connection between two civilizations that could have enriched each other never formed. After bottomry, someone else could absorb that downside, which meant the trader could now go on that voyage. As a result, new routes opened, new goods flowed, civilizations that had never traded before suddenly could.
Insurance has driven trade just as much as trade has driven insurance over the course of the centuries.
Bottomry lasted for nearly 2,000 years. The Phoenicians carried it across the Mediterranean, the Greeks refined it, the Romans codified it. Even the Silk Road had a hidden spine of risk-sharing instruments running beneath it that almost no history book ever mentions. And then Rome fell, and with it, the system. Until one afternoon in 1343, in a port city on the northwest coast of Italy, a notary named Tommaso Casanova sat down at his desk and wrote something down. Insurance wasn't invented in Mesopotamia. It was invented in Italy. It's 1343, and Genoa is one of the most commercially active cities on Earth. A city that essentially invented modern finance with double entry accounting, letters of credit, the first government bonds. Genoa grew wealthy by basically being better at trade than almost anyone else in the Mediterranean. But it had two problems: the Pope and pirates. Let's start with the Pope. In 1236, Pope Gregory IX condemned the sea loan, the direct descendant of Hammurabi's bottomry, as usury, the medieval term for lending money at high interest rates, which in the eyes of the Catholic Church was a serious sin, the kind that could get you excommunicated. The problem was that bottomry loans had been the backbone of maritime trade for nearly 2,000 years, and the merchants of Genoa were far too dependent on these instruments to simply stop. So they did what any reasonable medieval business people would do when the church told them their entire industry was sinful. They disguised it. So for over 150 years, the insurance contract, one of the most important financial instruments in history, spent its entire existence pretending to be something else. The first version of the disguise was called a mutuum, a fake sea loan. On paper, the merchant was lending money to the insurer for free, because free loans aren't usury. If the cargo arrived safely, the contract was canceled. If the cargo was lost, the insurer paid back the loan, which was functionally paying out a claim. The premium was paid in cash, not recorded anywhere, because recording it would be to put your sin in writing. Insurance didn't emerge cleanly into the world. It smuggled itself in contract by contract until it's too embedded in the global economy for anyone to stop it. But the Pope wasn't the only problem. The other problem connects directly to what's happening in the Strait of Hormuz right now: corsairs. Corsairs were essentially pirates with paperwork. Private citizens commissioned by governments to attack merchant ships of rival nations. Essentially, state-sponsored sea robbery. The most famous corsair was Francis Drake, who spent years plundering Spanish settlements in the Americas as an officially licensed privateer operating under a commission from Queen Elizabeth I. By the 13th and 14th centuries, corsairs were everywhere in the Mediterranean, and their presence created a new category of risk that merchants never had to price before. It was no longer just pricing the risk of a storm or bad luck. They now had to factor in the risk of a deliberate, politically motivated attack. The risk that your ship might be targeted specifically because of who you were and which flag you sailed under. Sound familiar? And this brings us to something genuinely extraordinary. The English word risk comes from the Arabic word risk, meaning chance or fortune. It traveled from medieval Arab Spain through the ports of the Mediterranean until it landed on a Genoese notary's desk, trying to describe the uncertainty of a voyage, the probability of catastrophe, the thing you were pricing when you agreed to absorb someone else's loss. Eventually, risk became resicum, resicum became risk. The word that now appears on every war risk slip at Lloyd's of London, including the ones assessing tankers transiting the Strait of Hormuz, can be traced directly back to a notary's desk in medieval Genoa. And then there's a detail that stops me every time. The same year Tommaso Casanova wrote the world's first standalone insurance contract in 1347, a different fleet of Genoese ships was docked in a trading port called Kaffa on the Black Sea. On those ships, in the cargo holds, was something that would kill between a third and half of everyone in Europe, the Black Plague. The trade network that made insurance necessary was the same trade network that carried history's most catastrophic pandemic. The merchants who invented a system to protect against catastrophic loss were, without knowing it, delivering it. But what those Genoese merchants understood that nobody had quite articulated before was that insurance wasn't just about protection. It was about information. See, Genoa's first underwriters were also its most well-traveled and connected traders. They knew which routes the corsairs were working, which captains could be trusted, which ports were reliable. All of that knowledge got baked into a price of a contract. So what they were actually selling wasn't coverage, it was knowledge. You were buying protection from someone who knew more than you, and the price you paid reflected exactly how dangerous they assessed your voyage to be. And that logic, that the person pricing the risk knows more than the person buying the coverage, is still the entire foundation of the insurance market today. It hasn't changed in 700 years. The nations that figured this out dominated trade. The ones that didn't fell behind. Insurance was never just paperwork. It was a competitive weapon. And for 2 centuries, Genoa did it better than anyone else, until a city further north decided to do it better. Before we get there, this is by far one of the hardest videos I've ever made. Not because of the research, I had all the facts. Babylonian debt contracts, Lloyd's coffee house, 4,000 years of maritime risk, but facts aren't a story. So I did what I always do when I'm stuck. I stopped asking for answers and started having a debate. My working thesis was insurance is the invisible infrastructure that shaped civilizations from ancient Babylon all the way to what's happening right now in the Strait of Hormuz. I put it to Claude and asked, point blank, am I totally off my rocker here? It politely called me out for assuming that because insurance existed alongside civilizational development, it therefore caused it. And apparently there's a specific term for this in historical analysis. It's called post hoc ergo propter hoc. Did we just learn a new Latin phrase together? I think we did. If I had the causation backwards, then my entire hypothesis collapses. So now I had to rethink the whole frame. The honest answer wasn't that insurance created trade or that trade created insurance. It's that they amplified each other across centuries in this feedback loop. Insurance didn't build civilizations, but it did lower the activation energy for the kind of risk-taking they needed to expand. And the Strait of Hormuz proved this in real time while I was making this video. When war risk insurance was withdrawn for tankers, it wasn't the drones or the Iranian Navy that stopped global shipping. It was the collapse of the risk transfer system underneath it. The invisible infrastructure suddenly became visible. That's the thesis, and I wouldn't have found it without being challenged first. Claude is not replacing my researcher, my fact checkers, or the 3 academic experts I interviewed for this video. It's a sparring partner I run my half-formed ideas past at midnight when I'm not ready to embarrass myself in front of an actual expert just yet. I don't want an AI that thinks for me. I want one that thinks with me and sends me away with even better questions. This video is sponsored by Anthropic. If you love digging deep and wrestling with complex ideas, the link's in the description. Try it on a problem you're genuinely stuck on, not a test prompt, a real one, because that is when the real thinking starts. After oil, coffee is the second most traded commodity on Earth. And we can actually give coffee at least partial credit for the modern insurance industry. I know that sounds like I just made that up, but stay with me. When coffee arrived in England in the early 1600s, it hit differently than anywhere else. Not because the English were particularly sophisticated about it, but because of what it wasn't. It wasn't alcohol. And in 17th century London, where the water wasn't safe to drink and low-grade ale was the default, a hot drink that made you sharper rather than slower was a revelation. The first coffee house opened in 1652. By 1734, there were thousands. The clever owners realized fast that coffee alone wasn't enough. What people really wanted was news. In a world with no daily newspaper and a postal system that took months, your best option for information was finding someone who knew something, and coffee houses became that place. For the price of a penny, any profession could walk in and access the collected knowledge of whoever happened to be in the room. They called them penny universities. Some coffee houses became so specialized, they became the institutions we know today. For example, Jonathan's and Exchange Alley, where merchants gathered to trade commodity prices, became the first modern stock exchange. London had, completely by accident, built a distributed intelligence network, and it ran entirely on caffeine. Into this world in 1686 entered a man named Edward Lloyd. Lloyd understood something his competitors didn't. The people who needed information most urgently were ship captains and merchants who had loaded everything they owned onto a vessel somewhere in the Atlantic with no way of knowing if it was still floating. So he built his coffee house specifically for them. He methodically sourced ship manifests, arrival records, departure schedules, commodity prices, and made Lloyd's the single best place in London to find out what was happening on the water. He built an information business, and then he let the merchants who gathered there start doing business with each other. But maritime trade wasn't any less risky. Fronting the money for a single expedition was still a huge gamble. So the question someone eventually had to ask was, what if you didn't have to carry all that risk yourself? What if you could spread it across a room full of people willing to bet that your ship would make it back? This is exactly what started happening at Lloyd's Coffee House. A merchant wanting to insure a cargo would write the voyage details on a slip of paper, the ship route, the value, etc., and pass it around the room. Anyone willing to take a share of the risk would sign their name underneath, along with a percentage of any loss they'd cover if something went wrong. So literally writing their name under the terms. That is where the word underwriter comes from the physical act of a man in a coffee house picking up a pen and signing his name under a description of risk. By the way, if you're finding this as interesting as I am, subscribe and follow the show because these are exactly the kind of stories we tell here on Today Learned. Anyways, Lloyd's wasn't an insurance company. It was just a room where risk was priced, negotiated, and distributed among the people most qualified to assess it because they were the same people who had spent their entire careers navigating it. The Genoese logic was now transplanted into a coffee house in London and operating at the scale of a global empire. By the early 1700s, Lloyd's was the most sophisticated maritime insurance operation in the world, built on coffee and information. And it kept growing into what it is today, which is not what most people think it is. Like I said, Lloyd's of London is not an insurance company. It's a marketplace. You can think of Lloyd's like a farmer's market. At a farmer's market, different vendors set up stalls. So you might have 3 people selling tomatoes, 2 selling bread, several selling cheese. Now, the market doesn't grow or sell anything itself. It's just the place where everything gets sold. And Lloyd's works exactly like that. Except instead of tomatoes and cheese, the stalls are insurance syndicates selling coverage. Multiple syndicates might be offering the same type of insurance, competing on price and terms. Lloyd's is just the venue. Which means between all those syndicates, you can insure pretty much anything. A supermodel's legs, a satellite before launch, or a shipping lane in an active war zone. The Genoese merchants in the 1340s, who each signed a share of a voyage's risk, were doing, in every way that matters, exactly what Lloyd's syndicates do today when each underwriter takes their line on a war risk slip for a Hormuz transit. Same structure, same logic, 600 years apart. Hammurabi's merchants price the risk of the Persian Gulf. Lloyd's syndicates are pricing it still.
The same sort of terminology was found, same phrases and terms of exemptions and what a policy would cover was replicated in the Lloyd standard policy on hull and goods of the 1770s, and in fact it continued right into the 21st century till quite recently. So there's been a long 400, 500 year tradition that you can trace it back to its medieval Italian or Mediterranean origins to some extent.
And here's the thing about building the world's most powerful risk marketplace. Eventually, someone will bring you a risk you really shouldn't be pricing. And in the 18th century, Lloyd said yes anyway. Here's something left out of almost every history book about the British Empire. Yes, Britain had the Navy, but none of that explains why British merchants kept out competing their Dutch, French, and Spanish rivals on trade routes they all had equal access to. The difference wasn't firepower, it was insurance. When Lloyd's underwriters were pricing maritime risk in the late 17th and early 18th centuries, they were doing it with decades of accumulated intelligence that no rival market could match. That meant British merchants could insure voyages more cheaply than anyone else, which meant they could take risks their competitors couldn't afford. Here's what that looks like. Let's say there are 2 merchants, one British, one Dutch, eyeing the same trade route to India. If something goes wrong, either of them could lose everything. The British merchant gets his coverage at a price that makes the voyage worth doing. The Dutch merchant is looking at premiums that would wipe out his margin before he's even left the dock. So the British merchant goes while the Dutch merchant stays home. Repeat that across hundreds of voyages over decades, and you don't just get a successful merchant, you get an entire empire. Insurance didn't just support British imperial expansion, it made it structurally possible. But the same mechanism that built the empire was also the mechanism that sustained one of the greatest atrocities in history. Lloyd's of London insured slave ships, not occasionally, but as a core business. Enslaved people were listed on policies as cargo, given a monetary value and insured against loss at sea. Loss meaning death, disease, or what documents called jettison, the same word used for throwing excess cargo overboard.
Slaves were repeatedly referred to, both in insurance codes of the 18th century and in court cases well into the 19th century, as the equivalent of essentially of livestock on board.
Insurance didn't just enable the slave trade, it normalized it. It took the death and suffering of human beings and turned it into a line item, a category of risk you could price, fund, and repeat. And this is one of the most important things this video is trying to say. Insurance is not neutral. What we choose to insure has always been a moral question dressed up in the language of mathematics. Which brings us to November 1781, the moment that dragged the whole system into the light. The Zong was a British slave ship carrying 442 enslaved Africans from Ghana to Jamaica. The voyage went wrong almost immediately.
The Zong was a ship that was actually was a Dutch ship that was captured by British privateers or English privateers off the coast of Africa. It already had 200 slaves on board. This was in September 1781. The ship was terribly overcrowded, really had only capacity for about 200 slaves, and there was over 400 on board. So it was very heavily crowded. But when he was heading for Jamaica, he ended up off the coast of Trinidad. He sailed away from Jamaica, completely confused about where he was, ended up several hundred miles out into the Atlantic, and then he began to worry that he didn't have enough provisions. He estimated he only had about 10 or 14 days worth of provisions, water and food for his cargo and crew. So he took a decision, a totally brutal decision, to throw a large part of about a quarter of his cargo overboard. And this took place over the course of about 4 days. Now, it was normal for slave ships to throw dead Africans overboard, to jettison them, as they would do a dead horse or a dead cow, on board. The unusual thing about the Zong was he was throwing live human beings, perfectly healthy human beings on board. He had them chained together, opened the cabin windows, and they were thrown in groups of 4 or 5 in chains into the sea over the course of about 4 or 5 days. You can imagine the terror of the Africans on board this ship. Anyway, the owners of the ship, the Gregson Syndicate back in Liverpool, almost immediately put a claim into the underwriters for the loss of their 130 slaves that they'd thrown overboard for their value, on the grounds that insurers would cover slaves jettisoned for the purposes of the safety and the security of the ship. And that's built into the standard Lloyd's policy of the time, perils of the sea.
Under maritime law, if enslaved people died of sickness at sea, owners couldn't claim insurance. But if they were thrown overboard as jettison, as a necessary sacrifice to save the ship, that was classified as a general average loss. Insurers would have to pay. Over the final days of November 1781, the crew of the Zong threw 132 enslaved Africans into the sea, alive. The owners filed an insurance claim and the insurers refused to pay. So the case went to court in 1783, not as a murder trial, but as an insurance dispute. The question before the court wasn't whether 132 human beings had been killed, it was whether the insurers were liable for the loss of cargo.
The insurance law was treating them as objects, or what the word they would have used was chattel, and that is possession. These kidnapped Africans were just thought to be objects, treated under law and insurance law as objects that could be thrown overboard without regard for their human reality.
A formerly enslaved man named Olaudah Equiano brought the case to abolitionist Granville Sharp. Sharp spent years trying to get murder charges brought against the crew.
The judge's name was Lord Mansfield. He said, "It is as though horses were thrown overboard." That's a very famous quotation from him. So that phrase is often thrown out to show his insensitivity, and certainly it does show his insensitivity. So Granville Sharp comes along, thanks to, by the way, freed Black man named Olaudah Equiano, who is one of my great heroes.
But Sharp's campaign made the details of the Zong public in a way the slave trade's atrocities almost never did. Abolitionists made it impossible to look away. The insurance dispute became a moral turning point.
Part of what this trial did when it became publicized, finally, is that people realized, wow, we are really treating people as though they are mere objects and are therefore, have no more protections under our laws than horses, right? I think it just forced people to face what slavery really was, when they preferred that it just kind of stay off to the side and stay over there so that they wouldn't have to look at what their country was getting so rich off of. And they had to realize this is a very hypocritical thing that they're allowing to happen if they're allowing the slave trade to continue.
In 1791, Parliament passed a law prohibiting insurance from paying out when enslaved people were murdered at sea. In 1807, Britain abolished the slave trade entirely. The Zong didn't do that alone, but the insurance framing 132 deaths reduced to a question of who pays made the case land in a way that pure moral argument had failed to do for decades. It made the machinery visible, and once visible for all to see, it became harder to defend.
It's extremely disturbing that we don't know their names, and I think equally disturbing that sometimes we can't even agree on the number of people that were murdered, right? As though it's, in and around 130 to 150 people. It's like each individual life is so important.
Lloyd's acknowledged this in part in 2020 when they issued a formal apology for his role in the slave trade. Whether that apology is adequate is something worth sitting with. What is certain is that the same institution, 4 centuries after Edward Lloyd opened his coffee house, is still the mechanism through which the world decides what moves and what doesn't.
Until you pointed me in the direction, I hadn't looked at Lloyd's apology. So I dug it up and had a look at it. And I'm kind of staggered, really. At no point in their statement did they actually say what their role in the slave trade was, right? Yeah, so I think it's a pretty bland statement. So I think I have to say it's as an insurance historian, it's pretty inadequate, I think.
Professor Pearson actually went out of his way to do the rough calculations of how much Lloyd's would owe in reparations for its involvement in the slave trade.
So I thought for this particular interview, I thought I'll just see if it's actually, because and often in restitution debates, one of the big questions is how do you put a value on compensation, right? Where do the values come from? I've done a back of the envelope calculation, and I think I can get a pretty good idea of what Lloyd's profits were in today's money. You get a figure of about £52 million net profit a year that Lloyd's would be making today if it was still insuring the slave trade as it was in the 1790s. Lloyd's pre-tax profits in 2024 were £9.6 billion. Okay, so net profits from the slave trade, translated in today's money, accounts for less than 1% of Lloyd's net profits today. So my argument would be, if you're talking about restitution, and these are based on the best figures we can get from the historical evidence, which Lloyd's obviously haven't bothered to look at or employ anybody to research, Lloyd's could, I think, fairly comfortably apply £50 million a year, based on 1790s figures, to, for example, education programs or maybe bursaries in African states that were affected by this, or Caribbean states that were affected by slavery. That's my spin on nobody's ever asked me to do this before, but it wasn't difficult to do.
That is an extraordinary amount of power for a marketplace that started with men passing slips of paper around a room. Before I tell you what happened in the strait, I need to explain the architecture, because without it, the story doesn't make sense. Every large commercial vessel carries multiple layers of insurance. Hull insurance covers the physical ship, cargo insurance covers what's inside, and then there's P&I insurance, protection and indemnity, which covers basically everything else. Crew injuries, environmental liability, port damage, and so on. Without P&I, a ship cannot legally enter most ports, cannot secure financing, cannot obtain cargo contracts. 12 organizations provide P&I insurance for roughly 90% of the global fleet. They're called the International Group of P&I Clubs. You've probably never heard of any of them. Guard, Norwegian, Skuld, also Norwegian, North Standard out of Newcastle, the London P&I Club, the American Club. They operate quietly, far from any headlines in cities most people would not associate with geopolitical power. They share catastrophic risk between themselves through a pooling arrangement, meaning if one club faces a loss too large to absorb alone, the others contribute. It's Hammurabi's bottomry logic scaled to cover 90% of the world's shipping. And running through all of it, setting the benchmark for every war risk decision, is Lloyd's. When Lloyd's designates a waterway as a war risk zone, it doesn't ban ships from going there. It just reprices the risk. But that repricing travels through the whole system almost instantly. The P&I clubs respond, hull underwriters respond, cargo insurers respond, and within hours, the cost of moving a ship through that waterway has changed dramatically, and every shipping company on Earth runs the same calculation. Is the margin on this voyage still worth the new premium? Before the current crisis, war risk premiums for Hormuz transit sat around 0.25% of the vessel's hull value. For a large tanker, that's roughly $250,000 per voyage. Not cheap, but manageable. Then the strikes began, and the math broke.
War risk premiums have risen, with insurance underwriters calling shipping through Hormuz as specialized coverage.
The affordability question has been really played down by the underwriters in London. There's one figure I saw from S&P Global, which is Standard & Poor's kind of online magazine. There was a tanker, a crude-laden tanker, this is in mid-March, which had been insured for $6.5 million to leave the Gulf and to head to wherever its destination was. $6.5 million. It paid an additional $7.5 million on top of that as what they call additional war risks premiums. So that seems to be a pretty hefty price burden to carry for any ship owner, you know.
Within hours of the first major attacks, the cancellation notices started going out from the P&I clubs. Not premium increases, straight up cancellations. Within 72 hours, all 12 members of the international group pulled their war risk coverage for the Gulf. By March 3rd, it was gone. Traffic through the strait, which had been running at over 100 ships a day, dropped 70%, then to near zero. Again, not because ships were blocked, but because ships were uninsurable.
And so the cost of insurance is basically proportional to the hazard, right? To how big the impact of the bad luck outcome would be, plus a normal rate of profit in the insurance industry, right? Which is affected by the competitive dynamics of the insurance industry. So, you know, if the probability approaches 100% that your ship is going to sink, then the cost of insurance approaches the cost of a new ship. And that would be prohibitive.
For tankers with American or Israeli corporate links, there was no coverage at any price. The risk had moved somewhere actuarial models simply couldn't follow. And when risk becomes genuinely unquantifiable, the system doesn't raise the price. It just stops. And here's where it connects back to everything we've already covered. Remember the corsairs of the 14th century? They targeted ships by flag. Genoese underwriters priced the risk of political identity into their contracts. 700 years later, Iran's targeting doctrine worked the same way. Ships with American or Israeli connections were charged 3 times more than neutral ones. The structural logic hasn't changed, only the names of the flags have. As a result, oil prices surged, gas prices rose around 50%, food prices climbed in markets thousands of kilometers from the Persian Gulf. But none of the people who made those decisions, the underwriters who sent out the cancellation notices, are generals or diplomats or heads of state. And yet, they move faster than any government or military response. They shut down the world's most critical energy corridor more effectively than any naval blockade, because a naval blockade can be challenged, negotiated, or broken by force. You can't sail a warship through an insurance gap. But here's the detail that makes the story complete. As the private insurance market collapsed, the United States government made a decision that hadn't been made in the modern era.
The United States is offering political risk insurance to any tankers operating in the Gulf, so we're putting up risk insurance. We'll go alongside of them for protection. We don't think it'll be necessary if it is. And if they do anything, the price will be incalculable.
It stepped in as a reinsurer of last resort, underwriting war risk coverage for Hormuz transits that the private market had abandoned. The country itself became the underwriter.
Now again, the United States has a bunch of national security laws on the books that give the government certain administrative powers that they don't have in peacetime, right? If you declare a national emergency, then the government can do certain things like provide this reinsurance, or can jump the queue of commercial contracts. So if there's a company that makes something that the government wants for the war, normally if the government goes to them and says, hey, we want to order, 1,000 widgets, they say, get in line. Okay, we have a backlog. You'll get yours in 6 months. We have a law on the books that says the government's allowed to say, well, for national security reasons, you're going to deliver ours first, and then you'll get around to all those other commercial customers.
Think about what that means. The Code of Hammurabi, the world's first formalized risk transfer system, was a state document, a king deciding that maritime risk would be governed by law. 3,700 years later, when the private market built on that foundation finally broke under the weight of a geopolitical crisis it couldn't price, a state stepped in and did exactly what Hammurabi did. It formalized the risk. It wrote the contract and declared the voyage can happen. So the circle doesn't just close. It closes in the same stretch of water, the Persian Gulf, where it all began. 4,000 years ago, a merchant in Babylon wrote a contract that said, if the boat sinks, the loan is forgiven. Risk was shared, the voyage happened, that contract became a practice, the practice became an industry, the industry became the invisible architecture underneath every civilization that has ever moved goods across dangerous waters. It outlasted Babylon and Rome, it survived the Black Death on the same ships that carried it, it moved from a notary's desk in Genoa to a coffee house in London to a glass tower in the city, and it's still there. Right now, doing exactly what it's always done, deciding what moves and what doesn't, what's possible and what isn't. Iran didn't close the Strait of Hormuz. A group of actuaries in London did, with cancellation notices in 72 hours. The weapon wasn't a missile. It was a pricing model that couldn't produce a number. Insurance is a thing civilization built to make the unbearable bearable. It is the hidden load-bearing wall, and it's been holding the weight of the world for 4,000 years. We just weren't told to look for it until now. If you enjoyed this video, make sure you're subscribed with notifications turned on to make sure you don't miss a single video. Thank you, and we'll see you next time.